The Federal Reserve just made a decision that affects your wallet. Yesterday, they held rates steady and signaled they're in no rush to cut them. If you've got a mortgage, a savings account, or credit card debt, this matters more than you might think. Let me break it down. I'm your host for Money Moves Daily, and today we're cutting through the noise on what the Fed's wait-and-see approach actually means for working professionals like you. Here's the headline number: 3.5 to 3.75%. That's where rates are staying. And that single number ripples through everything from your HELOC to your high-yield savings. And here's what caught my attention. The Fed now projects just one rate cut this entire year. One. That's down from what markets expected just months ago. The question isn't whether rates will drop. It's when and what you should do while you wait. Let's get into it. Let's rewind to yesterday afternoon. The Federal Open Market Committee wrapped up their two-day meeting with a decision that surprised almost no one: hold steady. But here's where it gets interesting. The vote was 11-1. Governor Stephen Miran dissented. He wanted a cut. That's a crack in the consensus worth watching. Jerome Powell stepped to the podium and delivered a message that was cautious, measured, and frankly, a little frustrating if you were hoping for relief. Powell said, and I quote, "The forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress." That's Fed speak for be patient. Why the caution? Two words: oil prices. The situation in the Strait of Hormuz has sent crude soaring past $110 a barrel. That changes everything. Powell acknowledged this directly. He said near-term inflation expectations have risen, quote, likely reflecting the substantial rise in oil prices caused by supply disruptions in the Middle East. When oil spikes, it doesn't just hit your gas tank, it flows through supply chains. Shipping costs rise, manufacturing gets more expensive, and eventually, that shows up in everything you buy. The Fed's updated projections show inflation ending 2026 at 2.7%. That's above their 2% target, and it explains the hesitation to cut rates too quickly. Think about what the Fed is balancing here. Cut rates too soon and you risk reigniting inflation. Hold too long and you might slow the economy more than necessary. Here's the good news buried in the data. The Fed still projects GDP growth of 2.4% for 2026. The economy is slowing, but it's not stalling. That matters. Powell described the current policy as restrictive, meaning rates are high enough to cool inflation without crushing growth. It's a tightrope walk, and so far, they haven't fallen. Markets didn't love the news. The Dow dropped 470 points, about 1%. The S&P 500 and NASDAQ each fell 0.7%. Volatility is the price of uncertainty. But here is perspective. A 1% drop isn't a crash. It's the market digesting information. Long-term investors have seen this movie before, and they know how it usually ends. What's really worth noting, mortgage rates are now projected to end 2026 around 5.9%. If you're shopping for a home, that's the number to watch, not today's headlines. So what does all this mean for you? Let's start with variable rate debt. If you've got a HELOC or an adjustable rate mortgage, the higher for longer message is clear. Higher for longer means your variable rates probably won't drop much this year. That credit card balance? It's going to stay expensive. Paying it down should be priority one. Here's a framework that historically tends to work. Rank your debts by interest rate. Attack the highest rate first while making minimums on the rest. The math favors aggression. Now, let's talk savings. Here's a silver lining in the hold. High-yield savings accounts and CDs are still offering attractive rates, and they're likely to stay elevated through mid-year. If you've been sitting on cash, this might be the moment to lock in a CD. Rates on savings products typically fall after the Fed cuts, and that cut could come later this year. Consider laddering your CDs, spreading your money across 3-month, 6-month, and 12-month terms. It gives you flexibility while capturing today's yields. Research suggests this approach balances access with return. For those watching the housing market, Powell's message requires patience. Mortgage rates aren't dropping tomorrow, but the projection toward 5.9% by year-end offers a glimmer of hope. Here's my take on mortgage timing. Don't try to catch the exact bottom. A rate you can afford today is better than a rate you might get tomorrow. Perfection is the enemy of progress. One thing worth noting, economists are divided on where inflation goes from here. The Peterson Institute warns it could exceed 4% by late 2026 if tariffs and oil pressures persist. Others, including the Congressional Budget Office, see inflation gradually cooling toward 2% by 2030. The honest answer? Nobody knows for certain, and anyone who claims otherwise is selling something. Powell himself acknowledged the uncertainty. He said, "Monetary policy is not on a preset course and we'll make our decisions on a meeting-by-meeting basis." Translation: they're watching the data, just like you should be. Let's talk about what this means for your investment portfolio. When the Fed signals patience, markets get nervous in the short term, but that nervousness often creates opportunity. If you've got a long-term investment plan, yesterday's announcement shouldn't change it. The Fed projects 2.4% GDP growth. The economy is fundamentally healthy. Stay the course. For your bond allocation, here is something to consider. Longer duration bonds may benefit if the Fed does cut later this year. But short-term bonds offer protection if inflation surprises to the upside. Diversification isn't just a buzzword, it's your insurance policy against being wrong. And in an environment this uncertain, being humble about what we don't know is the smartest move. Now, I want to address something I hear a lot. People ask, should I wait for rates to drop before making big financial moves? And the answer is, it depends. Waiting has a cost. If you need a car, your current one is breaking down and you can afford today's rates. The perfect rate 6 months from now doesn't help you today. Here's the framework I use. Make financial decisions based on your life timeline, not the Fed's timeline. If the purchase makes sense for your situation, rates are a factor, not the only factor. One more data point worth your attention. The February CPI report showed inflation at 2.4% annually, with core CPI at 2.5%. Those numbers were actually trending in the right direction before oil disrupted everything. The oil situation is the wild card nobody planned for. 20% of global supplies flow through the Strait of Hormuz. When that gets disrupted, the ripples hit every corner of the economy. Powell called the oil spike's effects potentially temporary. But here's the thing about temporary. It can last longer than your patience, and it can hurt your budget in the meantime. So here's what I'd recommend for the next few months. And this isn't financial advice, just perspective from someone watching the data. Build your cash cushion. Uncertainty favors the prepared. 3 months of expenses in liquid savings is the traditional rule. In an environment like this, 6 months provides more margin. If you're not there yet, make it a goal. Let me circle back to something important. The lone dissent from Governor Miran tells us the Fed isn't a monolith. There are real debates happening about whether policy is too tight. Miran wanted a quarter-point cut. He was outvoted 11-1. But dissents often signal where policy might head next. It's a breadcrumb worth following. History tells us that when Fed officials start breaking ranks, change is often on the horizon. One dissent today could become a majority tomorrow. Watch the pattern. For now, the smart money is watching 2 things: oil prices and inflation data. Those will determine whether the Fed cuts once this year or not at all. If you want to stay informed, and I think you should, set up a news alert for FOMC meetings and major economic releases. Know when to pay attention and when to tune out the noise. The next FOMC meeting is in May. Between now and then, we'll get more inflation data, employment numbers, and clarity on the oil situation. The picture will sharpen. In the meantime, focus on what you can control. Pay down high-interest debt. Build your emergency fund. Lock in CD rates if they make sense for your timeline. These are evergreen moves. And if you found this breakdown useful, consider subscribing. We cover stories like this every week, helping you make sense of the signals that matter for your money. Before I wrap up, let me share a framework for thinking about Fed decisions. It's not about predicting what they'll do. It's about understanding how their choices affect your options. When the Fed holds, debt stays expensive, savings stay rewarding, and patience is required for major purchases. That's where we are right now. Plan accordingly. The Fed's March hold tells us something important. They're not going to rush. They're watching oil, watching inflation, and waiting for clearer signals before they move. For you, that means this: focus on fundamentals. Pay down what's expensive. Save while yields are high, and don't let short-term headlines derail your long-term plan. This is Money Moves Daily. Remember, this is not financial advice. Always consult with a qualified advisor before making investment decisions. I'll see you next time. Make smart moves.